I always use an example of property taxes. It's a three-legged stool. There are three factors that determine what you actually pay in property taxes. You have your assessed valuation, the rollback, and then the levy rate. And so your assessed valuation, which all of us have received recently, so your assessed valuation is taken and then the rollback is applied to it. The rollback has been in place since 1979, and since 1980, the median rollback has been around 56%. So what that means is that 56% of your assessed valuation is what is actually taxable. So you take your assessed valuation, apply the rollback, and that determines your taxable valuation, and then you apply the consolidated levy rate, which determines what your property taxes are. So I always tell people when they get their assessment, if it has increased, it does not necessarily directly correlate into a property tax increase, but certainly your equity has increased in your home, which is a good thing.
I was going to say, I mean, let's be honest. In my job, what we're always looking for is your home to increase the value. It's an asset. It should appreciate. In a perfect world, that's what we like to see. So really, these valuations with the values going up is not a bad thing. It's a good thing because that's what this asset should do, right?
Right.
Sure beats like 2007, 8, and 9 when, if you guys remember, that's when we had the housing crisis and we were seeing people buying a house in 2008 and then their 2009 assessment coming out and their house was worth less than they bought it for. So the fact that your house went up a little bit is because of this housing boom that we've seen. So I wanted to jump in with that one.
One thing I should mention is that in current law, there are several property owner protections that where certain levy rates are limited so that it protects a property owner from experiencing huge increases in property taxes. For example, the state regulations currently restrict growth to an aggregate taxable value across the state 3%. They also have in place, like the city has in place, a general fund levy limitation of $8.10, which has been in place since 1972. So that there are several of those limit restrictions or rate restrictions that exist. Cities are also limited to having a 5% constitutional debt limit. So that means that we can't just issue debt out of control that would then come back and impact an individual property owner's levy rate. So these are the kinds of protections that are currently built into state law that help prevent even when you get like a large assessment increase, that does not necessarily equate into a large property tax increase.
So I reached out to a couple of my colleagues that are in the lending industry, mortgage lenders, bankers in general, and we started talking about this because I wanted other experts in opinion. And I was talking to Joe Hayho, he's over at Community Choice, and he was mentioning that for his family, his assessment went up $33,000 a year, which it seems like a big number. And I believe he's in Johnston. I'm pretty sure he's in Johnston. Anyway, his assessment went up $33,000 a year, which was 21%, which is pretty on par for the last 2 years of what we've seen in the real estate market. His impact to his family is $27.90 per month. And the way he put it, he's like, I have a family of 4, that's a trip to McDonald's once a month. Mm-hmm. So it's that 33,000 feels like a kick in the stomach and it's a shocker. But when you break it down to what you're actually paying, his taxes are not going up 21%.
Right. Right, exactly.
Even though there was a 21% growth in your assessed value, your taxes do not go up 21% necessarily.
Correct.
I mean, I think that's a safe thing to say.
Oh, that's an absolutely accurate thing to say, because bearing in mind of that $33,000 assessed value, only approximately 56% of that would be taxable.
But I wanted to talk, I think a big question people are having, should you fight your property tax value assessment? How is that done? I'm going to give you my personal opinion and my personal story. I'm in the business, so I have all the data and the facts at my fingertips. And for a long time, I had many rental properties. So when these would come out, it was, you know, 6 or 8 houses. So I, for years, fought every single one I ever had. I only ever won once. So I'm going to tell you that the chances of winning and overturning your assessment are slim. So I bet I've done it over 150 times, and I've only won once. And the only way that I was able to overturn my assessment was because they had the number of bedrooms and bathrooms wrong, and they had it higher than it was because there had been it was a data entry problem. Right. And so I was able to get that because how do I want to say this? I saw somebody on Facebook saying, "Oh my gosh, my house was built in the 90s and it's sitting out in all its honey oak glory, and my house needs to be remodeled." They're not assessing you on what color your woodwork or anything is. It's a very rudimentary calculation that they do. Have you ever tried to fight yours, and have you ever had any luck?
When I lived in the city of Des Moines, I did, and I was successful because mine was, for whatever reason, and I wonder if it wasn't just a transposition of numbers in data entry, but it was a townhome, and I was right next to a townhome that was, you know, same plan, same floor, you know, living square footage, et cetera, et cetera. And for whatever reason, ours was like $42,000 more than theirs, and the other ones in the whole complex. But that's the only time, because it wasn't comparable to the other comparable properties. But I would say, you know, I recently received, you know, like everybody else, received my assessed valuation notice, and it went up $55,000. And but I looked at that number and I thought, you know, honestly, I can sell my house for that. So the assessed value is supposed to be close to the market value. So that was my barometer. Mm-hmm. If I can sell it, if I feel like I could sell my house for that today, then I think that's a reasonable number.
I'd like to offer a couple silver linings or a couple ideas on how to use this information and your increased valuation to your benefit. One of the things that I was talking to a lender about today, it was actually Kurt Moore over at Lincoln Savings Bank. We had a luncheon or a breakfast this morning, and we were talking about this. He said, talk to people about removing their PMI. So PMI is your private mortgage insurance. So if you don't, when you bought your house, if you didn't put 20% down, they are charging you PMI. So what we can do, and I'm happy to help, and you'll reach out to your own lender or trusted realtor, but we can look at that and see if we can use your assessed value as a barometer, as my dad who's watching here would call it, a quick and dirty number, just a quick number. But if your property assessed value and what you owe on your mortgage is more than 20% equity, you may be able to reach out to your lender and remove your PMI from your loan, which can save you from $80 to $180 a month, which could be huge, which will more than offset probably what your increase in property taxes would be.
If you receive one.
If you receive it, yes. Not everybody did. So that's one thing. So if you want to reach out, we can talk about that. That's a fairly simple way to do that. We can look at that. There are a couple caveats in there, different kinds of loans and different rules qualify. But if you've got that, that's something to look at. Number two is there is other ways to use that equity you've got. So because this valuation came in, they are saying that you have equity in your house. I would say if you sell a large valuation, there's a good chance that it's correct, and you do have some more equity in your house than you had thought. A couple different things. Rather than moving, you can move and cash out that equity. That's one way. However, when you go to move, the houses you're going to buy, you're buying and selling in the same market, so it's kind of a wash. You're gonna put that equity somewhere else. The other thing that you can do is you can do a HELOC, or a home equity line of credit. And what that will do is you can reach out to your local bank or your credit union, and we can do a home equity line of credit, and we can pull out your equity to pay off higher interest rate debt. So for instance, if you've got a credit card at 15 to 20%, you could use that, and the HELOC rates are at 7 or 8 right now. So you could borrow against your equity. That's money that you've earned with your home going up in value. You take that HELOC and you pay off a high interest credit card. You'll still have a payment on that HELOC fund, but generally at that lower interest rate, it's going to pay off your debt a lot faster. So that's a good way to to spin this into a positive cash flow position for your family. Another thing is that maybe you're sitting on way more equity than you thought, and you've always wanted to buy an additional property. You could roll that money into the down payment on an income property or a second property or a vacation home or whatever you want. Maybe you make, I mean, honestly, you could buy a camper or a boat or anything you want. You could use that money for something that you want without taking out a loan. I guess the caveat with that is always pay off your debt first. And remember that if you're pulling out your equity now, when you go to sell your house, you may not have all that equity, but also you would have less debt. So I guess those would be the two things I really wanted to talk about, the PMI and the HELOC on those as two ways we can use this information and spin it into a positive cash flow position.